Hi everyone, my name is Darryl Panes, CEO of As Good as Gold Australia, and today once again I'm joined by my brother Brian and partner at As Good as Gold. And today, or this afternoon I should say, we're interviewing John Adams, Chief Economist at As Good as Gold Australia. Good afternoon, John.
Good afternoon,
Good
John.
afternoon, Darryl and Brian.
John, I believe a very important meeting took place last Tuesday night, just a couple of nights ago, where the RBA Governor, Dr. Philip Lowe, of course, spoke about monetary policy, and it was to a pretty important group, Australian Business Economists Annual Dinner. And I believe at this event, after listening to everything that Dr. Philip Lowe had to say, your worst fears were realised. And because a number of the points that he mentioned were quite contradictory. And it's a little bit like, if I may say, if we go back late 2007, a gentleman by the name of Ben Bernanke made some interesting comments at the time, made reference to the fact when asked the question how the economy was going, that everything was travelling well, and there was a reference to real estate as well, of course, as to whether real estate was in a bubble, and he said no, and we all know exactly what happened a few months after that. And so it would appear that Dr. Philip Lowe made strong reference initially to a very sound economy, and yet a number of the comments that he made and the policies that he talked about after that would indicate otherwise. So I'd like to ask you what the basic elements of that speech were.
Sure, Darryl. Thank you for the question. So Tuesday night, the RBA governor gave a speech about, quote, unconventional monetary policy. So conventional monetary policy is in terms of raising or lowering official interest rates. But since the GFC in particular, there's been a whole host of very exotic things that central banks have done around quantitative easing, negative interest rates, effectively printing money, debt monetization to basically keep this debt bubble going. And basically the speech was, it was looking at a paper that was recently published by the Bank for International Settlements, where they looked at four versions of unconventional policy, and they made some observations. Some touched on some so-called benefits, talked about some things that were negative about these policies, and then the governor talked about what do these policies mean for Australia and the Australian economy. And he sort of basically said that unconventional policy may be a feature of the landscape moving forward in Australia. He did express a model that he thought would be the most appropriate model for Australia in terms of all of these options. But then the most significant thing was that in the question and answer session, when he was pressed in terms of, basically if the world was to fall in, or if the sky was to fall in, what are you going to do? And he just said all options are on the table. And so a lot of the things that I've been talking about with you and Brian, but also with Martin North in terms of the war on cash, negative interest rates, quantitative easing, the cash ban, all of these things about losing freedom and basically losing your wealth in the process. When push comes to shove, he basically said all options are on the table, and basically there are no limits to what the RBA is willing to do if the economy, was to, fall into a downturn. And obviously, what he sort of referenced, and you sort of asked this in your question, he did say that their central scenario was that the economy has been slightly sluggish, and it's going to improve going into 2020 and 2021. So his basic scenario is that we won't have a need for unconventional policy in the next 2 years. And this is what he said on Tuesday night. And the most amazing thing, obviously, was that on Wednesday afternoon, Chief Economist Bill Evans from Westpac came out and said, no, they expect quantitative easing to start by about July, August next year, as in July, August 2020. So, the bank economist already saying that your rosy scenario for the economy is basically BS, and basically put on your seatbelt because the money printing is going to start, in quite dramatic fashion.
What a shame. I was thinking that you might have come up with some really interesting new policies that we could all get excited about moving forward, but that doesn't seem to have really been the case. So we're working with the same tools in the workshop that we have been for as long as I can remember. Which leads me to a very good point. You mentioned there are a number of policies or options, four options that were introduced by Dr. Philip Lowe. Can you just share with us what they may have been?
So the four options that the RBA governor spoke about at the dinner was negative interest rates, what they call extended liquidity operations. So that's what's basically happening in the US repo market now. So basically, when certain markets like the credit markets or the overnight interbank lending market, when that is short on money, they basically print money and pump that money into markets to keep them to have enough liquidity so that they continue to operate in a smooth fashion. The third option was quantitative easing. Or what I would call debt monetization.
Well, that's new. There's a new policy for you.
Yeah. Well, debt monetization has been happening for the last 1,000 years. When politicians and bureaucrats, when they just want to keep a debt bubble going, all they do is just print more and more of the stuff, yeah. And we have currency failures. So dangerous stuff there. And the fourth policy was what they call forward guidance. And forward guidance is basically statements by in terms of the central bank, and those statements are designed to shape expectations. So by basically saying where policy may go, you may start to change incentives, expectations. You may be able to induce people to increase investment, increase consumption, and by forward guidance, you could potentially move the economy in terms of growth, unemployment, inflation in a certain direction. Just by using words rather than actually changing any specific policy. So that's what forward guidance is. So they were the four things that the RBA governor referenced. Now, he did basically say that there were some benefits to these policies, and basically the whole purpose of unconventional policy is to drive interest rates lower, to make it more attractive to borrow, in order to spend, to invest. So obviously, when you've got a big debt bubble, and this is something that I've been saying for the last year, when you've got a big debt bubble, one of two things is effectively going to happen. It's either the debt bubble collapses and you have a deflationary, recession, depression, something of that nature, or if you want to keep that bubble going, you have to pump more debt into that bubble in order to inflate it. And how you do that is basically by printing money in more excessive amounts. So the whole purpose of doing this is by the governor's own words is to drive asset prices up and to drive the exchange rate lower. And the whole theory of this comes back from John Maynard Keynes, where in his book, in the 1936 book about the general theory, he talked about if people feel wealthier, even if if people feel wealthier, even if it's artificial, people are more likely to spend. So this is what economists call the wealth effect. And this was an observation Keynes made during some of his time spent in America in the late 1920s, before the stock market crashed in 1929. So that's the intent, and to some degree, the RBA governor said that some of these policies do work, and particularly quantitative easing, which is his preferred model in terms of what he'd like to go forward with. But also some of these policies come with some side effects and some negative consequences, and he also talked about that. Some of the consequences he referred to are more technical in nature, but the one that I just want to call out, which I think is quite significant, is that we've had versions of quantitative easing, and we've also had some limited versions of negative interest rates, mainly in Japan, but also in parts of Europe. And the issue is that once you start on this course of action, it is you can't reverse it, particularly with QE, because the purpose of QE. So what is quantitative easing? It's when the government central bank prints money to buy bonds at artificially high prices to drive the yields on the bonds down, or the interest rates down, And so, when they talk about normalizing the balance sheet in terms of trying to sell some of these bonds into the private market, well, the reality is that there's no buyers, because you bought this stuff when there was a lack of private sector demand, number one, and you bought them at artificially high prices. So if you're going to sell them at what the market is willing to pay, the central bank has to take a loss on these bonds. And just looking at, for example, what's happened with the Americans. The Americans took their balance sheet, the U.S. Federal Reserve, from $800 billion before the GFC up to $4.5 trillion with 3 rounds of QE. And then they said they want to do quantitative tightening, as in shrink the balance sheet. And they took it from $4.5 trillion down to $3.8 trillion. And now we've basically started since September of this year, a new version of quantitative easing. Although the Americans don't call it quantitative easing, they just call it these repo operations. But the balance sheet for the U.S. Federal Reserve has gone back above $4 trillion. So you look at the Japanese, the Bank of Japan owns about 50% of all Japanese government debt. And even if you look at the Europeans have done quantitative easing, and they can't get rid of these bonds off the balance sheet. And so this was a point that the governor did make during his speech. But one of the things that he didn't talk about, and this didn't come up in the question and answer session, was, well, if he prints money to buy either federal government or state government bonds, how is he going to get them off the balance sheet when things become normal again? And the reality is he can't. So, once you start this process, you can't go back. And that's why quantitative easing is very dangerous, particularly when you want to have a sound currency, low inflation, and you want to have a relatively stable money supply.
John, I can understand why other countries need to maybe take out these measures. But the one thing that has me a little confused is as to why we need in Australia to do this when you've got the governor saying, hey, the economy is sound. If the economy is sound, then why do we need to implement these policies?
The simple answer is the economy is not sound. The RBA governor and the government, and I still talk to people in Parliament on a regular basis. They keep on talking a positive story, but the reality is it's a very fundamentally a flawed economy. It's weak. It's getting weaker. We saw some numbers come out from the Australian Bureau of Statistics this week around construction. So the construction sector has taken a big hit. And we're seeing more signs that the economy is slowing. But on the other hand is, we have the biggest debt bubble in the history of Australia, and that debt bubble is slowly coming apart. And they're doing anything and everything that they can in order to stop that debt bubble from collapsing. And the only thing they can do is by printing more money. So that's basically what's going on. Now, it's remarkable that in the speech, there was a couple of things that the governor said. Was that one, in terms of the Australian context, he said that household debt, that's not a problem. I think those words will come back to haunt the RBA governor and the senior leadership of the RBA, because they keep on saying that we don't have too much debt, and the debt problem's not too bad, because if you look at the distribution of household debt, people with the relatively high incomes, they hold most of the debt. And so they keep on saying that, with the Americans before the GFC, poor people had a bulk of the debt, and we don't have that, therefore we have no problem. The only problem with that is that you look at Ireland before their housing market collapse, who had the bulk of the debt? Middle class Irish households, middle class to upper households had the bulk of the debt, and so our debt distribution is very similar to what the Irish had, and therefore all of these statements by the RBA that household debt is not a problem in this country. The statistical evidence just that it doesn't bear that to be the truth. So that's what he said that was concerning on the domestic front. But then on the international front, on the global front, he said that global growth has been quite sluggish, and we've seen some recent trade numbers. Global trade has been falling for 3 or 4 years consecutively. And one of the things he said was that one of the central global economic problems is we have too much savings. So he said we've got too
much. Too much.
That's right.
Okay, that's a different look. That's a different slant on things, isn't it?
At least we're hearing something different.
Yeah. So he basically said we have too much global savings, and we need to find ways around the world to unlock these savings that we can drive business investment up, so we can drive economic growth higher. And yet you look at the International Institute for Finance, and they said that by the end of June of 2019, global debt was at 250 trillion, or 320% of global GDP. And that is statistically the biggest global debt bubble in world history. So, so we don't have too much savings, we have too much debt. And they have to keep on pumping more and more debt into that bubble to suffer from collapsing. And so that's why moving forward, we're going to see even larger QE operations from central banks around the world, because they're getting more and more desperate. When things get desperate, I mean, when we have desperate times, there's a requirement for central banks to engage in more desperate policy, and that's what we're seeing going forward.
I want to butt in here, Darryl.
No, you can't do that.
No, I'm going to do it. That actually. One comment, and it doesn't gel on me, it doesn't make a lot of sense here, and that is that if a comment was made that we have too much savings, right? If we've got too much savings, therefore our household debt wouldn't be as great as it is. But we do know we have the greatest household debt in the world. Well, if that's the case, no, this is not working. There's something wrong with the system. You can't have too much savings and at the same time have the greatest household debt. So whoever's making these statements, I just don't think they've thought it through, Darryl.
No. Look, I think a lot of this has not been thought through. That's really the problem. And Philip Lowe, along with a number of other economists around the world, are just clutching at straws as I'm reading it. I mean, I'm not. I don't think you've mentioned this, John, but I believe that Philip Lowe also talked about the fact that, with reference to low interest rates, that this was damaging the profitability of commercial banks. Surely, they've already had one dagger in the heart. I mean, this wouldn't help their cause at all. And yet Philip Lowe's talking about continuing this reduction of interest rates. That would only make the condition worse for banks, wouldn't it?
Correct. Yeah. So in terms of bank profitability, he did make that point specifically around negative interest rates and what's been happening in the European context. So, but obviously banks are struggling to, we're seeing bank profitability fall because a lot of households are already tapped out. They've borrowed huge amounts of money. They're driving interest rates down, and we have seen a slight uptick in credit growth, but I don't think it's anything that the banks should be excited about. So that will affect bank profitability. But obviously, if we go into negative interest rates, the European experience has been that a lot of banks have struggled to make money because what is negative interest rates? Just for our viewers, it's when the central bank charges a negative interest rate on the reserves that banks hold with the central bank, and then the commercial banks have to make up that money in one form or another. And so far, so initially we saw some Danish banks start to charge retail customers with balances more than $1 million. Then they changed it down to $100,000 in terms of US dollars in terms of the Danish banks. And in a recent article that Martin North was telling about when we did our show yesterday, he basically said that some German banks are now saying that we're going to start charging all customers, whether you've got $1 in the bank or $1 million, and people will have to start paying these in terms of these negative interest rates. So for a while the banks were finding ways to absorb this cost by the central bank, but now that they've run out of options, and now they basically have to start confiscating people's wealth in terms of the banks, and obviously that would. That would concern a lot of people, and that would drive people to start pulling money out of the bank and holding money, whether it's in gold and silver or cash, outside of the banking system. Now, the RBA governor did say that there's so far limited evidence that cash hoarding is happening, but I expect that if you get middle class families being required to pay a negative interest rate on a sort of moderate. On a modest amount of savings or deposits, they're going to start pulling their money out of the bank, and we're going to see more cash hoarding, in terms of going forward. And that's why this whole campaign that I've been waging around this the $10,000 cash bill. I mean, that's what's so important, because everything, the AFR and others called me a conspiracy theorist, and yet the conspiracy is now coming into full force. But it's going to take a little bit more time. Probably in the next 1 to 2 years before people fully realize what the central bank is up to, what the commercial banks are up to, and how their savings and their wealth is being basically it's under attack.
Yeah, just very, very quickly, I have spoken to a lot of people of late, John, that have spoken to me and make it quite clear they have withdrawn cash out of their banks and they're holding the cash at home or somewhere. And I've suggested to them, of course, they want to get into precious metals. So how do we do that? And so my suggestion has been, a method of payment, bank transfer, and these people are shuddering because they're thinking, okay, I've now got to put my money back into an account, and it might only be for a few days, just a few days. But they're even concerned that something might happen in that few day period, prevent them from being able to access it and buy their precious metals. So there is genuine concern out there now from many of our clients and new prospective clients coming through.
I mean, look, probably in the last 4 to 6 weeks, I have heard a lot of stories of people struggling to get cash out of various institutions. So I'm working on something behind the scenes. I think I know what's going on, but I'm not ready to say anything publicly yet about what I think the real story behind that situation is. But no, we are, I'm getting more stories, and, my conversations with Martin North, he's hearing more stories as well, as in terms of, people are going in, and it could be people going in for, withdrawing $20,000, $50,000, and they say, I want the money in cash. And I've heard a whole host of examples of, sometimes they're saying, we don't have the cash on site, make an appointment, come back. Sometimes they'll say, what are you doing with the money? And there's one case in terms of Adelaide, where one of the big 4 banks have said, if you don't tell us what you're doing with the money, we're going to lock your account and you won't have access to your money until you reveal the full details. So we're starting to see some extreme behavior in terms of that. And then I've seen examples of where banks are trying to say to customers, can I give you a check? And people say, I don't want a check. I actually want physical notes, because if you take a check, you've got to be able to cash it in. So banks are reluctant to actually give legal tender out to customers who want to. And there's a big issue in the banking system that I think that's happening. I've been going back and forth with the RBA over the last couple of weeks, trying to get more information about certain details, and hopefully we'll have something significant to say about this issue in the next 2-3 weeks.
Excellent. John, we're just going to come back to quantitative easing for a second. But before I ask the question, Darryl and I were recently over in Sydney and we listened to Egon von Greyerz. And the speaker before Egon got up was talking about, I won't name him, but he was talking about the amount of gold that maybe should be in your portfolio. And the approximate amount was 5 to 10%. And then Egon von Greyerz got up and said, I don't know about you guys, but and you're talking about 5 or 10%. It sounds like we're living on. I'm about to be living on another planet. And everybody started laughing. And the reason why I bring this up, because I know that Europe, especially Europe, has done a lot of quantitative easing. And I just read an article yesterday that Germany, Great Britain, and Italy are so close to entering a recession, and yet these are the countries that are doing quantitative easing. And I'm thinking along the lines of maybe Dr. Philip Lowe thinks Australia is not on the same planet as all these other countries. And maybe you can explain, because my question is, the RBA has expressed a preference of launching quantitative easing if economic conditions require it, and if official interest rates are a quarter of a percent. So what does QE mean, and why are you concerned by it?
So the RBA government basically did express that once interest rates hit 0.25%, they would prefer to, they would start quantitative easing. And basically, quantitative easing is printing money to buy government bonds, and those bonds, could be federal government bonds, they could be state government bonds. I mean, that hasn't been determined yet. And the RBA is going to be looking at that problem, that issue going forward. But basically, they said that that would be their preferred model. Now, you have seen around the world examples of central banks buying private sector assets. So whether they're residential mortgage-backed securities, whether they're ETFs, whether they're actual shares or corporate bonds. Now, the RBA so far has said that they have no intention to do that, and their language was there's no appetite. So they didn't say never ever. They said there's no appetite, and they said that they would need to see problems in the mortgage market before they would intervene in the private and that particular sector. But basically, they've said that they would be looking at effectively buying government bonds to drive down the risk-free interest rate, and those interest rates are basically used by the private sector to set commercial interest rates for a whole host of debt products, lending products, mortgage interest rates, etc. So that's basically what they're hoping to do. And we sort of touched on this already in the interview that when you look at the international evidence, once you buy bonds at elevated prices to drive down in terms of driving down the interest rates on bonds. The question is, well, how do you unwind these? How do you try to get these off the balance sheet? And the reality is that you can't because there's a lack of private sector demand for these bonds at those prices. And so my concern is that once we start QE, we're not going to stop QE. We're never going to reverse the damage that's been done, and we're basically headed along a one-way track to some sort of currency failure.
Yeah, I see. Look, I don't see anything pretty about this. I mean, I'm looking at Germany, the greatest industrial powerhouse, which holds up Europe in general. And just looking at the other day that Audi, the car manufacturer, they employ 60,000 in Germany, and they're looking at removing 9,500 employees over this next very short term because they can't make any money. So I think we're heading down that direction. I think Germany would have tried many ways to get their economy moving, but with no success. So moving on to the next question, John, before Darryl, I think, ends our conversation here. How does the RBA governor's speech fit into with your economic Armageddon? How do you see it fitting into the Armageddon theory that you have?
So I published a series of articles for news.com.au last year, and one of the articles was, the title of the article was, it was Australia's, the 6 pathways to Australia's economic Armageddon. And basically what I did was I said that we're headed towards an extreme economic event, but that event, what that event may look like, it is unclear. And I mapped out 6 scenarios of how I think this is going to play out. So 3 of them were, more on the deflation side. So you're looking at a default on the foreign debt, a sovereign debt crisis, or even a recession/depression, and obviously that latter one is what for example, someone like a Harry Dent has been sort of talking about. But then I said, and the precondition for those sort of deflationary scenarios is quantitative tightening and rising interest rates. But then I said that if they reverse course, because when I was writing this at the time, interest rates were sort of going up halfway through last year. But I said if they do reverse course and they start to lower interest rates, we're going to see the crisis to be more of a inflationary nature. So I said it could be runaway inflation, kind of like what Peter Schiff has been saying. It could be stagflation, and this is what Alan Greenspan has been saying we're headed towards, or it could be a global currency crisis, which is what Jim Rickards has been saying. So it looks to me that and even when I talk to clients of As Good as Gold Australia, I keep on saying to people, just look at the language and the actions of the central banks. None of them are talking about raising interest rates. None of them are talking about being prudent with monetary policy or preserving the purchasing power of the currencies. They're all talking about printing. And the policy measures in the language is becoming more extreme as the as the global economy becomes sort of quite quite dire, and so I think moving forward we're going to see one of those three scenarios around high growth, runaway inflation, stagflation, which is effectively low growth, high unemployment, and runaway inflation. Or we're going to see a global currency crisis, kind of like what Jim Rickards has said, and so obviously in that context, if we are to see more more inflation, more money printing, there's a couple of key points to be made in terms of how this impacts the ordinary Aussie. And it's a point that you and Darryl has made in several interviews with me and some of our international guests, but it's also a point I've made in some of our seminars, is that you look at the last 1,000 years, where anytime you've had a fiat currency, every unbacked currency has always failed, because politicians and bureaucrats and central banks always print too much money. It always leads to a loss of confidence in the currency. It always leads to runaway inflation, hyperinflation, and always leads to currency failure. And so what it appears is that that's the path we're headed on. And some of these measures that the RBA governor has articulated, to my mind, they seem irreversible because of the reasons what we've outlined in terms of this interview. And so, what I would be, warning Australians across the country is to say that, look at the RBA governor's speech. He said he'd prefer to do quantitative easing, but if pushed, all options are on the table. There is no restraint if we go into an extreme economic situation where he needs to, do massive amounts of QE or negative interest rates. And any time these things have happened, we have had a failure of the currency, and that basically means that if you're holding Australian dollars, your purchasing power, your wealth, your ability to function in our society, that will be threatened. They'll become under attack, and basically people need to get a form of insurance, because what is gold and silver? Gold and silver has been around for 5,000 years. It's never failed. It continues to be in demand. It continues to hold purchasing power and wealth. And the reason why I've been buying silver in particular for the last 3 years, it's because I'm taking out insurance, because I don't trust the government and the central bank to manage the Australian dollar appropriately. So for those that don't want Australian dollars, and they're looking at foreign currency, and I've had some conversations with people about looking at foreign currencies. Well, it doesn't matter where you go in the world, whether it's the Japanese yen or the US dollar or the pound or the euro or the Swiss franc, they're all printing, and all of these currencies are basically headed in the same direction. Some are traveling faster than others, but yeah, we're headed towards some sort of extreme inflationary event, it would appear, and that has huge implications for economic outcomes, social outcomes, and how people on an individual basis should preserve their wealth. And people should look at history. People should look at how to get appropriate monetary insurance, and that's why I've been buying gold and silver, and that's why I'm here with you guys, and we've been together for 17 months.
To conclude on that point, I've read many books on the matter of monetary policies of around the world and fiat currencies, and it seems to be the average fiat currency does last about 40 years. We're at presently 48. The longest fiat currency I know of that that went to zero, but it lasted 51. So you look at 48 to 51, wouldn't be. I can't see anything going for 3 years. I would say certainly 3 years maximum, and we will see. We'll see gold and silver enter the monetary system again. Darryl, you got a question there?
I'm just going to say that, this extraordinary speech from Dr. Philip Lowe has massive ramifications attached to it, and you're right, John and Brian. This has never worked. All of the policies that he is talking about, or was talking about a couple of nights ago, have never worked, and we've just got to prepare ourselves as best we can for this, because if you look back. And John, you mentioned 1,000 years, and you can go back to ancient Egypt and Rome, of course, and even if 5,000 years ago, because they did the same things. Nothing has really changed in that respect. It's just amazing that we're heading down the same track. And if you go back 500 years. You go back 100 years ago. I mean, America didn't hold reserve currency status. Everyone sort of thinks, oh, America's, got the position of power. Well, yes, they do have now, but one would think not much longer. Prior to them, I mean, if you'd have been in the Bank of England and standing in a queue about to deposit some money, and you'd said to somebody, hey, we're going to lose this position. And World War I destroyed Great Britain, of course. The US provided goods and services to Great Britain, got paid back or got paid in gold, and accumulated this massive hoard of gold and placed them in the position they're in now. However, Great Britain held that position of power, but they ended up printing to pay for a war that they didn't win. And so, and you go back prior to that and you have a look, and it was the French, and you go back to that and it was the Dutch, and all of these great countries held that position of power for 100 years. That's why we look back at Rome and say, well, why isn't Rome the dominating force that it was then? For the same reasons. They debased their currency to pay for wars. And you can go back, from, we're talking about the Dutch for 100 years, they had it, and prior to that it was the Spanish, and prior to that it was the Portuguese. All of these countries had powerful navies, military, and that's where all the money went. So they printed their currency into oblivion to pay for wars. What's America been doing? Exactly the same. So we're now after hearing what you've just said, we're just heading down that same track. So, I mean, one has to ask the question, and we haven't got long to put all this together. So one's got to ask the question, Philip Lowe's speech on Tuesday night, how is this going to impact? We've spoken about this to some extent, but what would you suggest now Australians should do, because the time is getting close, to protect themselves as best they can with what we expect to see a major economic downturn? Where do we go from here? What are your recommendations? What do you think we need to do?
So one of the things that I would point out to our viewers is that I did write a 10-point preparation plan for news.com.au last year. There are 10 basic steps that I've sort of continued to tell people that they should be focusing on. Some are financial, some are non-financial. Why don't we put a link in the YouTube, in the YouTube comments for people to have a look at? We can put an image of it on the screen. That article is still available for people to view. Alternatively, people can contact me and they can sort of get access to that article. But some of the key points is, the first step I say to people, learn history, because what we're talking about, it's not new. It's been happening throughout our societies, throughout economies for a long time, and we're just going repeating history over and over again. So to understand where we are as a country, where we're headed, and obviously, Darryl, you've referred to a whole host of civilizations that have had currencies that have failed because they've printed too much money. So reading that history and understanding what that means from an economic point of view, a financial point of view, but also from a social point of view, I think that's important. Also, I would say that people should be holding forms of money that will hold that it would hold its purchasing power. And sometimes people think that if they've got a job and they've got money in the bank that they're safe. Well, just look at Venezuela. Inflation got so out of control in Venezuela that people who have jobs, that those wages were not enough in order to pay for in terms of basic goods and like food and transport, etc. So people should really be now focusing on trying to understand what happens when currencies fail. Obviously trying to understand some of these policies that the RBA is pushing forward, and then looking at different forms of monetary insurance that they can basically preserve their wealth, but also how to use gold and silver, when it comes to bartering. I've heard this consistently for the last 6 to 12 months that in Venezuela, if you have a 1 ounce silver coin, that's enough to buy you, 3-4 months worth of food. And now, will we get to those sort of extreme levels of hyperinflation in Australia? Probably not, and obviously I'm not hoping for that at all. But yeah, we could be headed towards much more inflation going forward. And one of the points that some of our international guests have said about America, and I would say this about Australia, is the government keeps on saying we have relatively low rates of inflation here, and yet everyone's saying the cost of living is the number one economic issue. So something doesn't gel there. So and even if you look at John Williams from shadowstats.com, if you measure inflation in the United States based on the methodology of the 1980s, inflation's not running at 2%; it's running closer to 10%, 9%, 10%. Yeah. So the reality is that inflation in Australia has been running at much higher rates than what the government is willing to admit. The ABS has made statistical changes, changes to its methodology over the last 20 to 25 years about how they measure the consumer price index. So people are already suffering from cost of living pressure. I think those pressures are going to exacerbate going forward, and people need to be focused on getting on top of in terms of the basics around shelter, food, transportation, etc. But also looking at forms of how do they protect their wealth because of currency debasement, and I should say that looking on history as we're headed towards some form of currency failure.
Yeah, I guess there's a little bit, and Brian and I constantly make reference to Jim Sinclair.
Absolutely.
And of course, we were fortunate enough just recently to interview Bill Holder, of course, Jim's partner. But Jim always talks about becoming your own central bank, doesn't he?
Yep.
Interesting enough, Brian, central banks, or most of them, hold gold.
Yep.
Right?
You can't have too much.
No. It protects their wealth, it protects their position, and yet for some crazy reason, governments don't emphasise that to us, mere mortals, as to why we should protect ourselves in a similar manner.
Absolutely.
But
Yeah, so the whole thing is they don't recognise that gold and silver as money, and you just can't have too much. Can you say you have too much money in the bank? Well, in currency you do have, but not gold and silver you can't have too much. So there you go. It can be used as money at any time.
Yeah, become your own central bank.
Absolutely.
Really, that's what it gets down to. John, look, once again, thank you so much for your input, mate. It's always first class. Always well researched, and I guess that's really what Australians need to do at the moment. They need to do their own research, and you're a very good first port of call, and because your information coming back is outstanding all the time. So I guess Australians have got a lot to think about moving forward. Some tough decisions, I guess, that will have to be made as this experiment plays out. Most importantly, right now, I would like to thank our viewers.
Absolutely.
Brian, as they are so important to us, our viewers and subscribers. Without them, of course, we wouldn't be here anyway. So we're very, very appreciative. And so at that, and thank you, John, once again. It's always a pleasure, mate. So I'd like to suggest to everyone, stay well, stay focused, and bye for now.
Bye for now.